So, you've probably been seeing all those pretty scary headlines lately, right? Inflation remains stubbornly high, economic growth is, well, sputtering, and global markets are definitely on edge. But what do all these clues actually mean for your money? Today, we're diving into one absolutely critical mystery. Are we actually entering a brand new era of stagflation? Now, to really understand this threat, we first have to define the dreaded S word, stagflation. It's essentially an economic nightmare scenario defined by a toxic rule of three. You've got persistently rising prices, slowing economic growth, and higher unemployment all happening at once. It literally breaks the traditional rules of economics. I mean, normally prices go up when the economy is booming, right? But with stagflation, you're paying way more for your groceries at the exact same time the economy is grinding to a halt. It's a total economic paradox. So, welcome to today's Explainer. We're about to unpack exactly what is happening in the global economy right now, and much more importantly, how you can actually navigate it. Let's look at the facts together. Here is our quick roadmap for today. Number 1, what is stagflation? Number 2, the current economic reality. Number 3, a fragmenting global economy. Number 4, the de-dollarization trend. And finally, number 5, strategies for your portfolio.
All right, let's jump right into part one. What is stagflation?
To really get this, we have to look backward. The 1970s gave us the absolute ultimate blueprint for a stagflation crisis. It all kicked off in 1971 when the US ended the Bretton Woods system, basically unpegging the dollar from gold. Then massive oil price shocks hit in 73 and 79. So you have this unchecked money supply colliding with severe energy shocks, which pushed inflation up to nearly 15%. Ultimately, Fed Chair Paul Volcker had to hike interest rates to a staggering 20% by 1981. He basically had to trigger severe recessions just to kill off that runaway inflation. Yeah, ouch. Which brings us to part 2, the current economic reality. Right now, the Federal Reserve is facing their ultimate nightmare dilemma. On one side, you have quantitative easing, lowering rates to stimulate growth, which unfortunately fuels inflation. On the other side is quantitative tightening, which is raising rates to cool that inflation down. The trap here? The exact medicine used to fight inflation makes borrowing incredibly expensive, which risks completely freezing the job market. You try to fix one side, and you break the other. It's like being stuck between a rock and a very hard place. And the data shows just how stuck they are. In June 2024, inflation hit a 3-year high of 4.2%, and that was mainly driven by sticky services and housing costs that just refused to budge. Now, the Fed has held their rate steady, but because the job market remains surprisingly resilient, they're essentially forced into this higher-for-longer trap. With markets currently pricing in a 58% probability of a September rate hike, the Fed is effectively cornered. So what's making this inflation so difficult to squash? That leads us to part 3, a fragmenting global economy. What is actually accelerating this stubborn inflation? Well, structural shocks. We are watching the global economy fragment right before our eyes. You've got these tit-for-tat US-China tariff hikes that are affecting nearly 2/3 of trade between those two giants. Then add in pandemic-era supply chain reevaluations and severe energy shocks from the Russia-Ukraine conflict. The end result? Geopolitical risk levels have surged 50% above their post-financial crisis average. And here's the reality. When the world fragments, costs go up and inflation sticks around. This global shift ties directly into part 4, the de-dollarization trend. I want you to focus on this one number for a second, 57.74%. That is the US dollar's current share of global reserves. Now, for decades, the dollar was totally unchallenged. But recently, driven by those geopolitical fractures we just talked about and the use of financial sanctions, global central banks are diversifying. This number represents a very meaningful retreat from the absolute dominance the dollar once held. And this brilliantly illustrates the shift. For the first time in modern monetary history, global official gold holdings have surged to virtually match foreign holdings of U.S. Treasuries. They are both sitting right around $3.9 trillion. We are looking at near parity here. Central banks are accumulating gold at historic rates, using it as a strategic anchor against all this global uncertainty. Okay, so what do we do about all this? Let's move to part 5, strategies for your portfolio. When you look at historical performance data, it uncovers this really fascinating counterintuitive pattern. Gold actually has a unique U-shaped performance relative to equities. Basically, it thrives at the extremes.
It acts as a powerful safe haven during market crashes, sure, but it also delivers incredible gains during exceptional bull markets. In ordinary, quiet times, its role is pretty muted. But it is the ultimate portfolio diversifier because it responds to major economic regime changes, not just the daily market noise. Now, if you're going to track just one single indicator to anticipate where gold is heading, watch the 10-year TIPS yield. Treasury inflation-protected securities strip out inflation expectations, which gives us the absolute cleanest real interest rate signal available. Right now, it's sitting at 2.21%. When real returns on risk-free government bonds are high, bonds win. But when they fall or go negative, that is exactly when gold shines. Tracking this specific number is how you stay ahead of the cycle.
So let's make this totally actionable with a step-by-step playbook. Let's imagine an investor named Sarah. Sarah doesn't panic. First, she builds a diversified core of global stocks, because over the long haul, equities still compound powerfully. Second, rather than giving into FOMO and dumping all her cash into gold at a record high, she sets a strategic target, say 5 to 7% of her portfolio, and she dollar cost averages into it over time. Finally, and this is absolutely crucial, she systematically rebalances. If gold spikes and hits 9% of her portfolio, she trims it back and buys stocks. If it lags, she tops it up. She is mechanically selling high and buying low, completely removing the emotion.
Just a really quick word of warning as you build this defense, though. Avoid the trap of leveraged and futures products. Anything promising 2x daily gold is built purely for short-term trading, and it mathematically decays over time. For genuine, long-term portfolio defense against stagflation, you just want to stick to simple, liquid, tax-sheltered, low-cost ETFs. Keep it simple, guys. Moving from being a reactive investor who panics at those scary headlines to an anticipatory investor who actually understands the data, well, that is what changes the game entirely. Stagflation is definitely a formidable economic challenge, but with a diversified core and some strategic allocations, you are fully equipped to navigate it. So the only question left for you is, are you going to sit back and wait for history to repeat itself? Or are you going to proactively position your portfolio for the cycle ahead?